Good morning. We are here to discuss building financial technology hubs of innovation, and we do so as a purported hub in FTX implodes in the Bahamas. So why don't we dive right in? Bob, how should we be thinking about this?
There's a start. FTX. There's so many angles to go at this from, but I think from someone who is an investor in financial services, very, very interested and focused on investing in technology, not just crypto really, but financial technology. I think to me, the biggest lesson here is about offshore versus onshore. I'm thinking about US when I say that. I'm thinking about operating outside the regulatory perimeter or inside the regulatory perimeter. And I think about the importance for this industry to embrace and celebrate regulation. And in the US, there's still some challenges where, the state regulators are very involved, but there's not clarity at the federal level. But having said that, as far as I know, there have been no situations like this that have happened in New York or inside the US regulatory perimeter, and I think that says a lot. So we're involved in the stablecoin end of technology, and within there we see real competition between offshore and onshore, and I think in my mind the FTX situation is going to bring some light to the differences there.
And Sopnendu, from a regulator's point of view, what is this?
The easiest answer is that we can say we are right about the risk part of this asset class, but I think we should take a step back and think about what happened. I think we've got to separate the business conduct issue with FTX and the innovation part, because if you try to commingle both, you may end up losing the core future-looking innovation which comes with this particular asset class. In our previous narrative, from a regulation perspective, we have always said that there are this interesting innovation in this space. When you tokenize assets, or you tokenize the whole process which drives a process of moving goods from A to B, when you make the interesting innovation on the payment instrument, there's a whole set of things happening on the innovation side. Of course, Bitcoin as an asset, for example, has failed as a payment instrument, but it has given a lot of opportunity to think differently, how to use that technology to think about the completely new way of thinking about how to design a money which will work in the Web 3.0 world. And from that technology outcome, we have seen that there is a whole set of new innovation coming on the currency itself. From now we call it so-called stable coin, but assuming it is a well-regulated stable coin or a central bank digital currencies or bank-backed deposit tokens, the whole set of new definition of a new form of money is getting created as a response to the future of finance in the Web 3.0 world. To end my thinking here, I think we should not forget why this industry was created at the first place. Today, the act of paying for a certain transfer of good is one process, and the ownership happens T+3, T+2, T+1, 3 days or 2 days after the ownership of the asset itself. This technology allows it to merge into a single transaction where the transfer of ownership and the transfer of value happens atomically, instantly. That itself is a massive innovation and a massive breakthrough in the financial sector. And if you can get that right, I think we have a long way to go. But the currency which facilitates this transfer of ownership doesn't necessarily have to be a cryptocurrency, a privately backed currency. What it can be a whole range of currencies which comes along with that as part of innovation.
I mean, the whole crypto world is so much a part of the bleeding edge of innovation in finance at the moment. What is the regulators, or what are regulators' role in winning back trust now that the FTX situation has?
Sorry, I didn't get the last part. Sorry.
I mean, do you think the regulators have a role here to bring back trust in this whole ecosystem?
Well, I think there are many ways to think about trust, right? I think by the process of getting regulated doesn't necessarily get you the trust. You have to deliver to the regulatory expectation of any of this licensed activity. I think if that's the question you're asking, that how do you develop the trust? But when you get a license, there are a whole set of things you have to comply to, from know your customer to business conduct to consumer protection to transparency, the whole set of expectation to even the whole the viability of the business model also is a part of the consideration. So just because you are regulated doesn't mean it comes as a trust. You have to deliver to the trust because you are a license holder, and there's a whole lot of things to be done.
I mean, Tom, I think for there to be trust, there's a few preconditions. I think we need to believe that there is a regulatory framework that is supportive of a stable environment and information, and we need to believe that there is a radical transparency in terms of the data and the information that an investor would need. And I go back to my first comment about onshore, offshore, transparency, non-transparency, and I look at those portfolios in stablecoins which have a full radical transparency, audited position. Everyone knows a dollar is a dollar is a dollar, or a euro is a euro is a euro in a stablecoin, versus many, and we saw some earlier this year with Terra and Luna, where it was opaque, arithmetic, not clear, not transparent, and we saw kind of a run on that stablecoin. And if you think about that, a run on a stablecoin is not very stable. So we go right to the very, very heart of the regulatory framework that defines, much like it would for a money market fund, what can be invested in and what can't be invested in. And then that followed with a radical transparency so the investors or the users can actually see that that's being complied with.
And how would you like to see that play out? Is the regulator supposed to be driving innovation in sort of a loud channel, or should they be just sitting back and watching and trying to create a sort of nebulous but stable area, playpen or area where people can come up with private ideas and sort of float them out?
Let me take a crack, and then you come. But using the U.S. as an example, and it would be very different here in Singapore. It would be different maybe in Europe. But let's just use U.S. as my example, and where we're very involved with USDC and the development of a stablecoin, versus should there be a Fed-developed central bank digital currency. What most of us all agree with is there should be a digital version of the dollar. That's going to add efficiency to financial services. We can talk more about it. It's going to add inclusivity. But the question is, should it be developed by the Fed and the government, or should it, and the regulators, or should it be developed by private actors? And I think if you go back to simple things like the development of the Fed wire, that was not developed by the Fed. That was developed by the private sector and then regulated. And my sense is that the Fed is both unwilling and unable in many ways to develop, are they the right institution to develop a world-class technology that's needed for an efficient digital version of the dollar, or should they allow the private sector, highly regulated, to work toward that? And I think that high regulation would include real clarity about if they're going to allow a USDC, for example, that there's transparency about what's in the portfolio, how it's managed, and are we sure that a dollar is a dollar is a dollar? And so I know in that case, they've gone to great pains to provide clarity that there's 80% of the money backing USDC is in 3-month treasury bills and less. 20% is in cash. It's at these 7 banks. It's segregated in client accounts. The T-bills are managed by, in this case, Bank of New York. That kind of transparency allows people to make a judgment. And that kind of, and if we had more of bank regulation over this as well, I think this would accelerate quite nicely. And I worry that, in some alternative scenarios in China, for example, it would be very natural that the central bank in China is responsible for that central bank digital currency. But in the US, there's just such a history here of innovation coming from the private sector, but supported by very, very strong regulation from the government.
Well, from Singapore perspective, we started this journey in 2016 when this whole digital blockchain, DLT, digital currency, Bitcoin came in place. So we started from the point of a use case. And in 2016, we started, and I always say that in the world of technology, the best way to make policy is through experiments, rather than through a long, drawn process of watching the industry evolve. And after 10 years, you come back with a policy, the technology has been outdated. You're essentially regulating an outdated technology. So instead of getting into the trap of policy on a 10 years lag to a new technology, the best way is to experiment together. So in 2016, we started Project Ubin as a big experimental effort from MAS to look at the technology and the role of digital currencies. And the use case we picked up was payment instrument, because that's what Bitcoin was promising in 2016. That is an efficient payment instrument. So what happened in 2016 in Singapore, we looked at existing payment mechanism, and we deployed something called Pay Now, which allows two people to send money to each other at 0 cost, 3 clicks. And then we asked the question to ourselves, why do you need a Bitcoin when I can send money in 3 clicks at 0 cost, just knowing your mobile phone number, your national ID? Then you looked at, and we deployed that. It was a huge success. And at the same time, we are doing Project Ubin, phase 1, phase 2, phase 3. On the phase 4 and 5, we decided to pivot to cross-border transfer. Can we connect a Pay Now system to something similar in a country like Thailand? And we started the project of connecting Pay Now to a PromptPay, a Pay Now equivalent in Thailand, to see whether this two payment system can connect and can we achieve the same level of efficiency. Before the connection, it was to take between 10 to 15% for every $100 you sent to Thailand. After the connection, we brought down the cost structure to 3%. Then again, we asked a question to ourselves, what is the role of a digital currency? I think we concluded by saying that the 3% can it be less than 1%, and that can be solved with some amount of certainty by using a digital currency, which essentially automates 3 things: reconciliation, settlement, and the transfer. And that's where we established there is a role for wholesale CBDC. So that's step 1. In the meantime, we looked at, is there alternate way to look at this currency? And we went to capital market, where we started a whole set of projects looking at, can you represent the asset in this network so that the asset transactions on this on the marketplace can be super efficient. We started Project Guardian and whole set of projects around that. So from MAS perspective, we are doing this series of experiments and convincing ourselves the real value of this particular asset class. So one way to look at as a payment instrument, other way to look at an asset class itself. As a payment instrument, we have landed on a wholesale CBDC. We landed on a retail CBDC. There's a particular use case which can support that particular need for a retail CBDC. And we have been very open about that a well-regulated stablecoin can be answered to a low-value transfer cross-border. It truly builds a much more efficient construct for a low-value transfer when it comes to stablecoin. Of course, there's a competing platforms to that. On the market side, I think it's absolutely clear the current inefficiency in the market, especially the role of intermediaries, can be removed by this new way of representing assets in the token form. And all this requires a trusted exchange. So there's a need for infrastructure like a good exchange, a good custody services, a good way to issue tokens, and a whole network on the protocols which can make it look safe, sound, and secure. So I think our approach has been experiment, very thoughtful licensing, and some market research and market, I'll say, a sense of understanding how the market is progressing. So we will watch and progress relative to the way the innovation is moving. So it will not be innovation or the regulation is ahead of innovation, nor we want the innovation to be way ahead of the regulation. There's a huge gap, and you have the arbitrage situation now where unregulated entities are causing massive havoc to the industry. So you don't want that. You don't want to have that big gap between regulation and the innovation. Also,
What does an experimenting regulator actually?
Sorry?
What does an experimenting regulator actually look and feel like? How do you interact with?
I think we must have an outcome. It must demonstrate a clear value. And so that's how we look at, we define a clear outcome. We publish a set of public documentation and source code. People see it and they understand how it works. As a regulator, we don't have a liberty to experiment with things where there's no outcome. It is left to private sector to figure it out. But when it comes to public policymakers, our boundaries of experiment are limited to outcomes, and which has to be demonstrated.
This is one, Tom, I think this is one of the great examples of the different approach of Singapore versus the US, where you have the dollar, the largest currency, in a much different approach. Or here in Singapore, you have, I mean, to be perfectly frank, I think with FTX, Singapore can now own the moment. There has been a debacle in the market, and it's supportive of the kind of things that you've been doing. But for Singapore, you know, to reinforce its reputation as a strong regulator, radical transparency, and become a hub for innovation and regulation really is a window to Asia, I think is a phenomenal opportunity. I think the position for Singapore is probably better today than it was a week ago in some ways.
Because we have been consistently saying that we should not run ahead of ourselves on this particular space, because it has to be a steady building block. You got to have a trusted exchange. You got to have regulation which ensures good business conduct or market conduct. You got to have real use case in the market to drive adoption of these tokens. So I think bringing it all together, Singapore can do a meaningful role in this space, so that we bring all the components of success in a way it looks logical and has a clear future outcome.
I guess to take things back to basics, a level, is what you're saying the outcome of innovation should be to smooth over inefficiencies or solve problems in the market? Or how do you approach more radical innovation that is rethinking the way markets should work or solving problems we didn't know we had?
Yes. Well, sorry.
No, go. I have a few thoughts, but I think you going first would be appropriate.
But if the question is how do you go about it, right? That's essentially your question, right?
Yeah.
Well, you know, good thing about people, if you bring them together with a problem statement, they know how to figure it out. The Singapore model always has been a consortium based. Bring the policymakers, bring the market participants, give them the right incentive, create a program, and let them solve the problem. So people know how to solve the problem. In the regulated industry, there's always a lookout for, are the regulators comfortable with that experiment? What MAS is doing, it's signaling to the market that we are willing to innovate, we are willing to experiment, go ahead and do it, as long as it is constrained by a certain boundaries where you're not creating systemic risk or you're not creating market failure. So as long as we define that boundaries, we can move in that direction. So navigating through that boundary constraint is the art of making experiment work, and how to get the market participants to genuinely solve the problem. Many a times we have seen that market participants have a fear of competition also. And how do you also eliminate that unknown fear of unknown, that participating on a common good is not competition. It is a collective good for the industry to do better what they're doing. So you also have to navigate that complex, unstated issue on the when it comes to experiments.
So I think that's a great structure for Singapore. I think in the US there's a different issue, which is that particularly post the 2008 financial crisis, frankly, the concentration of the larger systemic banks has become greater, not less. The banks are far safer, capital levels are higher, behavior has been terrific, but the truth is over 50% of the deposits in the US are in 4 banks. So the concentration and the risk of that concentration to the system has been greater. Not necessarily the risk of a collapse, but the other risks that happen when the business is concentrated. So lack of inclusion, lack of transparency, maybe higher costs. So the great experiment with the digital currency is really taking the simple example of this. There's a company here in Singapore and a company in the US where we're going to send $100 million. The way it works today is the Singapore company will go to DBS or some other local bank. They'll contact the bank in the US for the US corporate. They'll go through their KYC. They'll go through a whole bunch of process. It'll take 2 or 3 days. And if today's Tuesday, is it? You lose track when you're traveling, or it's Wednesday, isn't it? Yeah. It'll probably be wired on Friday or next Monday, and it would be quite expensive. With a digital currency, with the technology of the blockchain and the public rails, that can be done like this. We can do it right now on the internet, 24/7, at the speed of light, with the security of the rails of the internet, and it's driving the cost pretty close to zero. This is an incredible innovation, which when you're in a dollar market where there are this many business-to-business transactions, you can actually transform, you know, the underbelly of the core banking business.
So just to add, you know, when we do experiment in Singapore, I just want to make it very clear, we don't do it only for Singapore, because this is a highly connected market. One thing we make, if you have observed our last 4 years of our experiments in MAS, always there's a multiple country involved in this process, because regulations cannot be super efficient in one jurisdiction. It has to have a network effect. And how do you draw? In fact, we are working with France, we're working with US on a lot of these experiments. So drawing regulators to a common purpose across jurisdiction is also a key part of the success. That, if you think about BIS, after so many years, did finally decided that they will open an innovation hub, which kind of gives central banks some comfort coming through BIS and doing this experiment. BIS has more than perhaps 10 sites globally where they're doing innovation. So central banks through BIS construct can also find a safer way to experiment on digital currencies. To me, that whole BIS journey, last 3-4 years, is a key enabler for central banks to be far more open and far more indulging in CBDCs and digital currencies.
What do you both think the role of banks is in all this? Are they leaders? Are they followers? How does innovation enter the banking system?
You want to go, Rob?
Well, I think it starts with their incentive. I think the incentive for DBS in Singapore would be different for JP Morgan in the US. So to some extent, and I'll go back to what I said earlier, and I'd love your view on this, but if you look at the larger interconnected banks that post-2008, what we referred to as the systemic banks, are too big to fail, they've become larger, they have become more concentrated, they have become closer and closer to their governments for both good reasons and bad. You look at the TAR program, or you look at a lot of things that happened during COVID, there was great cooperation. Sounds to me a lot like a utility. So they're becoming a lot more utility-like, which is that they're really safe, they are really entrenched, but they are not a home of agile, mobile innovation and risk-taking. So in those larger banks, that innovation is by definition going to have to come from outside of the banking system. And I think it's somewhat different in smaller countries,
yes.
But certainly in the US, if we're counting on the 4 banks with over 50% of the deposits in a regulatory environment with very high capital levels, which if we're counting on that for the innovation, good luck. It's not going to happen. That's not America. I'm sorry, that's not America.
Well, there are many ways to reflect on this question. Let's be honest about one thing, that banks did not necessarily started this whole transformation by themselves. It was a fintech which created that fear, which forced banks to start thinking differently. I remember in 2015, when I took the job as the chief fintech officer at MAS, the total amount of fintech investment was like, difficult to count, around $20 million, largely 80% allocated to fintechs who are in the business of moving money, payments fintech. Last year, Singapore fintech investment was $4 billion US, direct investment. And you look at where the money has gone. Almost 80% of the money has gone to fintechs who are in the business of helping banks to digitize faster. So clearly, over the last 5-6 years, banks have taken this as a collaborative tool especially with the fintechs, to help them to digitize faster. Because one advantage fintechs have, they pick up a business product or business model or business value, they put the best technology, and they're unrelentlessly focused on making it world-class. What banks got to do now is to unbundle their core architecture and create pipes. And what is happening in Singapore, in many Asian countries, banks have created this whole APIs where they're waiting for a good partner to plug in instead of trying to do everything themselves. So this journey of trying to do everything and not doing a great job about it to a completely different architecture where you have a core banking system with a lot of pipes waiting for collaboration to be plugged in, with fintechs around you trying to help you digitize faster, has truly made that big impact in the financial sector for regulated entities. Now, I used to joke about this, that if you go to tech companies and ask them, give your sectorial revenue projects where you make money, I think financial sector was somewhere between 40 to 50% of the revenues for a tech company. But you look at the tech stack of by sector, the financial sector used to have the oldest tech stack. So as an industry, we pay the biggest bill and we have the oldest technology. How did we land up this thing? Because there is also something, I think regulators in the regulated world, you have something called tech risk management guidelines. So banks are very scared to try out new technology because they want the technology to mature to a level where you have comfortable to deploy in your own system. Because as regulators do look at your tech stack as a stable system supporting a critical bank like a last 4 bank in the US. So there is this fear of adopting new technology. With this changing regulatory stance, allowing more collaboration, I think banks have truly moved to a direction of a better tech stack, much better user experience. And of course, you can always say which bank is better than other bank, but that is a work in progress.
Does the whole FTX collapse renew that fear of the new for banks, and can it take the wind out of the sails here?
Will it take us back? I think people are very resilient and they clearly figure out what is bad, what is good. I think we have seen in history, even the dot-com crash. If you go back to the great dot-com bust, 3 things were happening same time: new business model, new infrastructure, and new consumer adoption process. When you have 3 variables evolving, the market is designed to fail quickly because all 3 are immature. And what came out of it is a massive infrastructure which was largely built. What you will see now, that we have the same situation. We have a new business model, you have a very early stage infrastructure, and we have a very early stage consumer adoption in this particular space. All this incident like FTX will see a complete collapse of the business models. What will be left is great infrastructure where billions of dollars has gone in. What will come after this is good business model, good consumer adoption. People will understand what it means. On a long run, you'll get a better outcome.
And better regulation,
yes.
Better, smarter
yes.
regulation. So first principles, I think it was really well answered. First principles, could we see this kind of innovation and development within the banking system? No way. The regulatory environment, the regulators do not want banks to be taking that kind of risk. It does not fit our system. So that happening outside the banking system, I think, was what we should expect, that kind of innovation in the kind of exchange that FTX was, it wouldn't be appropriate to be happening within a bank. But first principles, what did we also learn? I think what we will learn, I think you hit it spot on, is that this is a great exchange with great technology where there was conduct and behavior issues that were totally unacceptable, and that there was some real lessons learned in terms of the onshore, offshore regulatory perimeter. How could we have caught it, earlier? So I think the conduct and business behavior is clear. I think lessons for regulators are not quite as clear, but pretty clear. And I think what we'll find out, I agree with you, is that there's some great technology here
yes.
that we'll learn from, and someone's going to pick that technology.
And it's already built.
He's probably sitting right there.
Yeah. Yes. So
Does Singapore need to have some response to?
Sorry?
Does Singapore need to have some response to this disaster to move forward with?
Well, we will. I think from our perspective, nothing changes. This is, as Bob said, this is a business conduct, market conduct issue. We should not confuse with innovation and the technology progress. So from MA's perspective, we stay on the course. We stay on the business case driven approach to this space. We stay on course on good regulation. We are always going to discover an efficient way to do financial sector or build financial sector. Our future of finance is clearly in 3 areas: how to embed finance in real economy, how to decentralize some of this structural inefficiency we have today, and how to move to sustainable finance. If digital currency and this technology can help to solve those 3 problems, we stay on course.
To me, this is so crystal clear. In my 40 years of banking, I've had the privilege of working with Singapore. At Barclays, we did a lot of our technology and financial analysis right here. We took advantage of the incredible training that comes in the Singapore universities. So I'm very, very comfortable in understanding a lot of the benefits here. This is Singapore's moment. Singapore should own this. They have a brand and reputation around innovation, around
Absolutely.
regulation.
Thank you for that.
This is Singapore's moment. And where else in Asia would you say this kind of opportunity exists as a hub of financial innovation and kind of a gateway to Asia? I think this is like
I agree
a home
with you.
run.
I think as long as we know what to do with this currency is fine. Till now, I don't know what to do with the cryptocurrency other than speculation. So as long as we find a path to get there in a sensible way, we should get there. But purely building an economy out of speculation with no underlying is just a bad idea.
Well, let's also finally use this. I'd love to see this as an opportunity to kind of separate FTT, a token. No one knows how to value it. Bitcoin can make you a lot of money. How do you value it? Versus U.S. digital currency, which is $1 is $1 is $1.
Yes.
It's not crypto, it's financial technology, it's payments infrastructure,
Yes.
it's the efficiency of the banking system, it's inclusion. It's very, very different. And I hope part of
Yes.
this is that we start to understand and get some transparency below the hood.
Seconds to go. If I could quickly get a last word from each of you. What do you see as the most exciting place or exciting innovation that's happening right now?
On this same digital currency space or broadly?
Anywhere.
Well, I'm going to take 2 big bets. I still believe that this whole Web 3.0 technology, as we call it, does have a lot of legs to solve the capital market infrastructure issues we have today. I think we can do a far better job in moving assets across the network. That's absolutely clear to me. And Project Guardian is one of the way MAS is moving forward. The second the space I believe that's the multi-trillion-dollar industry for fintech industry is the green or ESG fintech. Because that industry, partly due to regulation, partly due to the SDG 2050 goals, we will see a massive repurposing of fintech to solve that problem. There's a data problem out there. There's a data provenance problem out there. Some of the blockchain technology can solve that. And there's a lot of business model to be solved by using fintech as a core technology approach to solve this problem. So that's a multi-million-dollar business opportunity lying there to repurpose all the fintech to focus on sustainability.
Listen, I agree with that, and I would say it's not Bitcoin, it's not FTT, it's not Luna. Think about the infrastructure, which is my way of saying the financial technology that's improving inclusion and efficiency of the banking system. And I think about the developments that blockchain has taught us, and I think about the developments that a stablecoin, or I hate the word stablecoin, a digital version of the major currencies are teaching to us. And I think the next 5 years are a great opportunity to get these over the line. And I think in the US, seeing the private sector develop a digital version of the dollar that brings all the benefits I talked about, and a regulatory framework around those, probably driven by the Fed, because this is a banking product, we can have such progress in the next 5 years. It gets me really excited.
Tom, I can't help this. Somebody told me that speculation is good. It helps in price discovery. And my response is, it has to be a real asset to do a price discovery. You can't speculate on asset which doesn't exist.
Yeah.
So speculation by itself is not a bad thing. It allows a price discovery, as we know. But what is happening today is absolutely insane. We've got to stop this. I'm very happy that this thing happened. People will finally wake up and see real value.
It's a great point. Gentlemen, thank you for a fascinating discussion. Bob and Sopnendu, thank you very much.
Thank you.
Tom.